You look at the Wipro charts from Friday, and I mean, it looks like a crime scene.
Oh, yeah.
A 7.4% drop in a single session.
Huge volume, too.
The ADRs went from nearly $3 down to what, $2.75? The volume was just screaming over 12 million shares, which is more than double the usual activity. It has all the hallmarks of a complete disaster quarter.
Right.
But here's the thing that's driving me crazy. When you actually open the books, the company made more money than expected. Revenue beat, margins expanded. So we had to figure out, why did the market panic?
It's the classic disconnect, isn't it? It's the rear view mirror versus the windshield. You're right. The numbers looking backward were solid. Wipro delivered a pretty clean quarter in a messy environment.
For sure.
But the market isn't paying for what you did yesterday. It's paying for what you're going to do tomorrow. And on that front, Wipro basically told investors, don't get your hopes up.
Okay, so let's unpack the good first, just to establish the baseline. Because frankly, this sell-off implies the business is broken, and the P&L suggests otherwise.
Yeah, let's do it.
They pulled in $2.622 billion in revenue. That's up 5.5% year over year.
And in constant currency, they grew 1.4% sequentially.
Right, and keep in mind, the street was modeling $2.61 billion, so this is a beat.
It's a slight beat, sure, but in the IT services game right now, just crossing the finish line without tripping is, well, it's an achievement.
That's a good point.
But the real story, the one that should have had the bulls excited, is the margin profile.
Right, the operating margin hit 17.6%.
Up 40 basis points from last quarter.
Which is huge. Management was essentially doing a victory lap on the call about this, calling it one of their best margin performances in a long, long time.
And in an inflationary environment where wage pressure is still a thing, holding a 17.6 handle that's legitimate operational discipline.
It is. It shows they have the levers to control costs, even when top-line growth isn't, exploding.
They've tightened the belt, optimized utilization, and they are squeezing more profit out of every dollar of revenue. If you are a value investor, that is exactly what you want to see. A steady ship.
But then we get to the earnings per share, and this is where the algorithms probably just lost their minds at 8:30 a.m.
Yeah.
Reported EPS came in at 3.1 cents. The consensus was 4 cents. That looks like a massive miss.
It's what we call an optical miss. It looks bad at a glance, like missing a step on the stairs. But when you realize there was a one-time charge, the whole picture changes.
What was the charge?
They had a specific hit regarding a labor code change, basically a gratuity expense increase that they had to book.
So it's an accounting anomaly, not an operational failure.
Exactly. If you strip that out, which any human analyst would do, but an algorithm might not, the adjusted EPS was 4.1 cents.
So fundamentally, they beat on the bottom line, too.
They made more profit per share than the street expected, assuming you ignore that one specific legislative chart.
Okay, so let's recap the setup. Revenue beat, margins expanded, adjusted earnings beat, and the stock tanks 7%. This brings us to the air pocket, the guidance. This is where the narrative shifts from steady ship to, dead in the water.
This is the killer. They're guiding for Q4 IT services revenue of, $2.635 billion to $2.688 billion.
Okay.
Now, put that into a growth percentage. That implies 0% to plus 2% sequential growth.
In constant curve.
0% in a tech bull market. You cannot tell investors you're pivoting to AI and transforming the future and then forecast zero growth. That's not stagnation. Relative to inflation and competitors, that feels like moving backward.
And that's why the stock repriced. Flat is the new down.
Absolutely.
And the explanation from the CFO, Aparna Iyer, it was telling. She gave us two reasons. One was fewer working days, which is the standard seasonal excuse everyone just rolls their eyes at.
Right. But the second one, delayed ramp-ups.
Delayed ramp-ups. That is corporate speak for the client signed the contract, we pop the champagne, and now they won't pick up the phone to start the project.
Precisely. It's uncertainty. It means the total contract value, the TCV numbers they love to brag about, aren't converting into billable cash flow fast enough.
It's code for demand softness.
It is. The client is worried about their own budget, so they push the start date from January to maybe March or maybe even to June.
It just feels like a wait-and-see approach from the enterprise clients. They're holding on to their cash until they see which way the macro winds are going to blow.
And for a stock like Wipro, that is just toxic. The market hates uncertainty more than it hates bad news.
That's true.
If you tell the market, we lost the deal, the stock drops and it finds a floor. If you tell the market the deal is signed but we don't know when the money is coming, the market assumes the absolute worst.
It assumes that Q4 revenue might slide into Q1, or maybe it disappears entirely.
Yep. And looking at the broader context, this isn't happening in a vacuum. Wipro just closed the acquisition of Harman DTS in Q3.
Right. CEO Srini Pallia was talking it up, emphasizing the engineering capabilities and the design to manufacturing entry.
Yeah.
But acquisitions are messy. How does this play into the numbers?
The strategic fit, it makes sense on paper. Wipro needs more engineering heft, and Harman gives them a foothold in new geographies.
Okay.
It actually contributed about 0.8% to the growth in Q3.
So nearly a full % of their growth came from buying revenue, not from organic sales.
Which means organic growth was even more anemic than the headline suggests.
Correct. But the real friction is on the margins. The CFO is very transparent that Harman is dilutive in the near term.
So you get a situation where organic growth is stalling, that 0 to 2% guide, and at the same time, you're integrating a company that drags down your best metric, which is that 17.6% margin.
That is a tough corner to paint yourself into.
Yeah, they are trying to hold that 17 to 17.6% band. That's their Maginot line. But integrating Harman while the top line is flat creates immense pressure. You can't hide operational inefficiency when you don't have growth to cover it up.
You really can't.
Exactly. The market is doing the math and saying, okay, if revenue is flat and margins are under pressure from the buyout, where is the earnings growth coming from next quarter? And the answer is there isn't any.
That's why you sell.
Yeah.
And meanwhile, to distract from the flat growth, management is just shouting AI from the rooftops.
Yeah.
I think the phrase was AI first and a board-level mandate.
The knuckles. It is.
It feels like if you don't say AI 5 times in your opening remarks, the algorithm automatically sells your stock.
It's the bingo card for 2026. You have to say generative, transformation, and mandate. But to give them credit, they aren't just using buzzwords. They did lay out specific platforms, Wings and WeGA.
Let's actually dig into those, because usually these acronyms are just vaporware, but they seem to be pretty central to the strategy. Wings is described as an ops delivery accelerator, and WeGA is focused on the development lifecycle. What does that actually mean for a client?
Okay, so think of Wings as the plumbing for AI. Everyone wants the sexy chatbot or the predictive model, right? But you can't build that on top of a messy legacy database. Wings is the infrastructure tool that cleans up the business processes and the IT backbone so that AI can actually function. It's the unsexy work that has to happen first.
Before the transformation. And WeGA?
WeGA is for the developers. It's code generation, model tuning. It's about making the engineers faster. They gave a few examples. A UK education provider using Wings for a secure operating model, a US fitness tech company using both for a subscription shift.
So the activity is real. They are building things. But my question is this generating new revenue, or is this just cannibalizing their old business?
That is the multi-billion-dollar question for the whole industry. The CEO explicitly said the pipeline is driven by cost optimization.
Wait, say that again?
Clients are cutting costs to fund these AI experiments.
So Wipro helps a client automate 10 back-office jobs. The client fires those people, takes the savings, and gives a piece of it back to Wipro to build an AI pilot.
That is the cynical but likely accurate view. It's a save now, spend later environment.
And the problem is that cost takeout revenue is deflationary. It shrinks the deal sizes.
Exactly. Meanwhile, the AI transformation revenue hasn't scaled enough to offset that shrinkage. That's why you get 0% growth. You are running just to stand still.
That is a terrifying dynamic. You're cannibalizing your steady legacy income for speculative AI income that hasn't fully matured yet.
It's the valley of death. They have to cross it. Management is betting the house that cost optimization today becomes AI transformation tomorrow, but right now they are in the middle of the bridge and it's windy.
Let's break this down by sector then, because the pain wasn't distributed equally.
Right.
If you're holding the bag on Wipro, where are you finding any comfort?
You're looking at healthcare and banking. Healthcare was up 4.2% sequentially. BFSI banking and financial services up 2.6%. Those are the defensive, steady Eddie sectors. When the economy gets weird, banks and hospitals still need their systems to run.
But the blast radius was clearly in consumer and energy.
Consumer was ugly, down 5.7% year over year. Management explicitly blamed two things: a large SAP program that got put on hold.
Again, delayed ramp-ups.
And tariffs. And that tariff keyword is something every macro investor needs to be watching right now.
Oh, for sure. If trade wars heat up, the consumer vertical gets crushed because those companies operate on such thin margins with complex supply chains.
They cut IT spend immediately.
Immediately.
Correct. And energy, or EMR, was down 5.8%. They cited macro uncertainty and supply chain disruptions. So you have your cyclical sectors, consumer and energy, taking a beating, while your defensive sectors hold the line. It's a textbook recessionary spending pattern.
Geographically, it was interesting, too, a tale of two Americas and a surprisingly strong Europe.
Europe was the hero of the quarter. It grew 3.3% quarter over quarter. They ramped up a mega deal there. Without Europe, this quarter would have been a disaster.
Really?
Yeah. America's 1, which holds healthcare and consumer, is growing, but America's 2 is declining. It just shows how lumpy the revenue is right now. One mega deal in Europe can mask weakness across half the U.S.
Okay, let's zoom out for a second. We've established the fundamentals are shaky but profitable. The growth is basically non-existent. But we need to look at the balance sheet because, frankly, this is the only thing keeping the stock from falling into the abyss.
I agree.
They are sitting on a literal mountain of cash.
It is a fortress balance sheet. Gross cash is at $6.5 billion.
$6.5 billion.
To put that in perspective, that's a massive chunk of their market capitalization. And operating cash flow was 135% of net income. Even if they aren't growing, they are a cash-generating machine.
And I can't just sit on $6.5 billion forever. Activist investors will start circling if they do.
Exactly. They declared an interim dividend of 6 rupees, total payout over 1.3 billion for the year. But the real juice, the thing that might save the bulls, is the buyback.
The CFO was surprisingly direct about this during the Q&A. Usually they hedge, but she was pretty specific.
She confirmed buybacks are on the table, and crucially, she noted that the statutory conditions are met. There are no merger impediments anymore.
And Wipro has a history of doing buybacks when the stock gets beaten down.
They do. So picture this. The stock is at 52-week lows, around 2.75 cents. They have $6.5 billion in the bank. They have cleared the decks on restructuring. They took a $31 million charge this quarter to finish that up. Why wouldn't they step in and buy their own stock?
It's the most logical move. It puts a floor under the price. It tells the market, we think we are undervalued.
It's the buyback put. If you are shorting the stock, you have to be terrified of waking up one morning to a massive buyback announcement that rips the face off your position.
Which brings us to the so what. We aren't here to just read the news. We're here to find the angle. We've looked at the wreckage. We've analyzed the engine. The company is stalling, but it's rich.
And that combination creates a very specific type of opportunity. It's not a growth story. It's a mean reversion story.
All right, this is the part of the deep dive where we get a little dangerous. We're going to pitch a trade idea. And I need to be very clear. This is not financial advice.
Not at all.
We are two voices on a recording. We are not your fiduciary. Do your own diligence. If you lose money, that's on you. But looking at this disconnect, I see a setup.
I call this the mean reversion pairs trade. It's for the contrarian out there who thinks the market has gotten a little too emotional.
Lay it out for us. What's the structure?
Okay, first look at the divergence. Over the last year, the tech ETF, the XLK, is up about 26%.
Right.
Wipro is down 20%. That is a massive 46-point spread. The market is pricing Wipro as if it's broken and pricing the broader tech sector for absolute perfection.
And your argument is that Wipro isn't broken, it's just boring.
Exactly. The earnings showed stagnation, not disaster. Margins are holding at 17.6. They have that $6.5 billion cash pile. At 275, the stock is trading near 52-week lows. The downside is capped by that cash and the impending buyback. It's hard to see it going to zero from here.
So you go long Wipro.
You go long Wipro, WIT. You are buying the valuation floor. You are betting that the delayed ramp-ups eventually happen in Q1 or Q2 of FY27, and you are betting that management announces a buyback to defend the share price.
But you don't just hold it naked, you hedge it.
Right. You short the XLK, or if you want more volatility, you short a high-beta AI pure play that has run up way too fast. You are hedging the broader tech exposure.
I see the logic. If the whole tech sector cools off, say, the AI bubble bursts a little bit, your short prints money. If tech keeps ripping, Wipro likely gets dragged up with the tide because it's so cheap compared to everything else.
Precisely. You are betting on the gap closing. Even if the market corrects, Wipro has already fallen 7% post-earnings. It has less room to drop than an NVIDIA or a Microsoft. It's a defensive play disguised as a tech trade.
But every trade has a widowmaker scenario. Where does this blow up in our face?
The value trap risk. If that Q4 growth comes in at 0%, the bottom of the guide and margins slip because the Harman integration is messier than expected, the stock just becomes dead money. It could sit at 275 for 6 months or drift to 250.
And in a pairs trade, time is your enemy. You're paying the carry cost on the short, and if the long doesn't move, you're just bleeding slowly.
That's the risk. You need a catalyst. You need that buyback announcement or a sign that the delayed ramp-ups are actually starting.
But with a dividend yield kicking in and that cash pile, it feels like an asymmetric bet. The market has priced in a disaster. We just saw the numbers. It wasn't a disaster. It's just a quarter. And in this market, is actionable when the price is down 7%.
It's not sexy. It's not going to the moon. But it's the kind of trade that pays the rent when the hype cycle dies down.
So, bringing it all back home. Wipro Q3 FY26, a good margin story at 17.6% and a decent revenue beat, all obscured by an optical EPS miss and a terrifyingly flat growth guide.
And the culprit is client hesitation and, seasonal weakness. Management is betting the house that they can pivot from cost optimization to AI transformation before the cash runs out.
Right.
They have the platforms Wings, WeGA, and they have the acquisition Harman. Now they just need the clients to sign the checks.
The clock is ticking. They've cleared the restructuring charges. They have the cash. Q4 needs to be the bottom. If they guide weak for Q1 next year, all bets are off. But for now, that cash pile looks mighty attractive at these levels.
Keep your stops tight. Watch for the buyback news. That's the signal.
Thanks for joining us on this dive. It's ugly out there, but that's usually where the opportunity hides. Keep your eyes on the tape.